Shaquille O'Neal said his single best investment he ever made was an annuity. And it wasn't because it was the best ROI. It probably was the worst ROI of anything he had in his portfolio at the time. But he bought it after he almost lost all of his money because I think at 55 it would pay him a couple $1 million a year. In his head, he knew he had secured it, and then he took way more risk.
Right.
That's where I guess I'm trying to work with these entrepreneurs to say at one point, when you have it, secure it, and then go even more risk. Instead of what happens is they get older, they just keep taking risks, and then they just pull back risk on their business, and then their business dies.
Yeah.
What's up, everybody? Welcome back to a brand new episode of the None of Your Business podcast. Shawn and Lacey here with you, just as we are each and every week. And just like every week, we have a super amazing guest that I am super excited to present to all of you. I have known our guest for a little while now, and I've got to tell you that in every single interaction, it is just so genuine, which I'm not trying to create any stereotypes, but in the business that he is in, that's not always
may not be what you think of.
I'm going to welcome in Shea Swenson. He's the co-founder and CEO of Stonebriar Financial. He has done so much work to improve the financial literacy and financial position of people of all ages. And that's what I love about him, is that he has an incredible book of business where he's really stewarding and being teaching people how to be a faithful steward of their finances, a lot of them sort of in the mid to late part of their lives. But he has this portion of him that really focuses on the younger generation, which that's something that is unique. A lot of times people that are in the financial space are like, listen, why am I going to talk to these guys? They don't even have any money yet. He also is very influential in his community. So, oh my gosh, you guys are going to learn so much. Shea Swenson, welcome to the None of Your Business podcast.
Appreciate it, man. Excited to be here.
I love this. Let's start with this question because I haven't asked it in a little while.
I have a good question too.
One of the things is if people watch you on social media, you have a lot of really interesting clients. You are super connected in the sports world, the golf community. And so people probably think like, wow, lucky Shea, like he has it all made. I wish that I could just, I'm a financial advisor. I one day want to be like him, but I never can because Shea just, he had it all made for him. Right. But I know, because I've spent a little time with you, we've had some dinners together. I know that's not always been the case. Tell us a little bit about this come-up journey. How do you get to be Shea Swenson?
Yeah, I think it starts, there's always the origin story. Parents weren't married. My mom was an alcoholic, drug addict. She lost custody of me and my older half-siblings when I was about 8 or 9. So I got put on a plane and moved to Blanding, Utah, which is...
Where is that?
Yes, exactly. An hour south of, from Clearwater Beach, right?
Clearwater.
One of the beautiful beaches.
Off to Blanding, Utah.
Blanding, Utah in December. It was the first time I'd ever seen snow in my life.
Oh, wow.
And you fly to Salt Lake, and then Blanding's 5 hours south of Salt Lake. And so you're on the four corners. So New Mexico, Arizona, Nevada, or... Arizona, New Mexico, Colorado, and Utah. So if you ever watch Forrest Gump when he's running and he stops, like that's literally 20 minutes from my hometown.
Oh my
So less than 3,000 people. It hasn't grown in population in 70 years, right? It's the same people. My grandfather started the football program there and is kind of a little legend in that town. And so they took me in when I was 10. And so I think some of the beginning is like I grew up, and because of all that, kind of a little bit more independent than probably most. I saw things that most people didn't see at that time. But I had great, amazing grandparents that kind of took care of me, they didn't try to parent me, they just let me be, but they gave me, the needs that I needed at the time. But really, to kind of answer your question, I served a Mormon mission for 2 years, and taking the religion out of it, the greatest skills that I could have ever learned was those 2 years. I was in California, and knocking on people's doors, talking about religion is one of the hardest things to do outside probably politics. Both of those, and it all weaves together nowadays, anyways. and so I think coming off the mission, I had a confidence that I probably didn't have growing up. Of like, okay, I can go out. I met amazing people, whether in my faith or not my faith, that were doing incredible things. So I think some of the fear was taken away. But I ended up working for two brothers that were in the wealth management space, and really quickly, to answer your question, I started to realize this entire space was built for the wealthy, right? Like the best advisors in the world are going to help the wealthiest people. a doctor, right? A surgeon, they could do heart surgery on a 2-year-old and an 80-year-old and really get paid the same.
Right.
Right. And so their skill set can be used at very any age. In the financial world, an 18-year-old doesn't have any money.
Right.
So the problem is all of the problems that I fix for my 60-year-old clients could have been fixed if they would have had better education at 18. So it's this never-ending process of the issues that happen probably until now of technology. I think technology changes the world, but the origin was I got in the industry, kind of knew business development, helped these two brothers scale their business. They got to be close to $1 billion under management. But after a few years, I knew I wanted to leave and do my own because I wanted to do it a little bit differently. I wanted to make sure, we have to make money. You're a business. You have to make money. You have to do the things to make sure bills are paid. But at the same time, why are you doing it?
Yeah.
Are we actually helping people in it?
It's really interesting because even when you said in the introduction, how genuine the interactions are with Shea, and that most people may not think about that when they think financial advisor or wealth management.
Yeah.
No, the most successful financial advisors that I know are I don't even know if they know anything. Like I don't know if Shea knows anything about financial
We haven't
products.
tested it out yet. Yeah.
But they are just masters at relationships.
Yes,
they get
absolutely.
people.
Absolutely. But what I'm wondering too is what do you think kind of the biggest objections or paradigms people have, misjudgments around what you do
in the industry?
Yeah.
The industry, and it was right when I was 18 years old, one of the first companies that was called was a insurance wealth management company that wanted me to sign me up. Got to get skin in the game. I remember it was like, you pay $200 and then you can be on our team.
Yeah.
And then go bring your 5 to 10 friends and family in.
Yeah.
And let me close them. And then I'll pay you a little bit for it. And really, they didn't care about you. Because if you brought 5 to 10 people, even if you never worked another day in your life, they got 5 to 10 leads. It was amazing.
Yeah.
That's the game. And there's other businesses like that. And so that has done, finance has been around forever. So it's not like doTERRA or some of these other things that come up here and there. Like this has been around forever, and it's kind of been done this way for a long time.
I was going to say it's a very similar model.
Actually, similar model.
Like network marketing.
It's the network marketing, which is I think there's definitely a place for that. And
Sure.
I think as much as maybe there's criticism, there's a place. But in the wealth management space, it's a little interesting because you've got 18-year-old kids that they know nothing.
Right.
Right? Then they just met this guy and they're like, oh, please come talk to this guy.
Yeah.
He knows everything about wealth management. And it's just not true. And so I was actually, I started at 18 in the industry. I actually did that for like 6 months.
Oh, wow.
And was like, no, I'll never do this again. And so when I went and worked for those two brothers, they wanted to hire me as an advisor. And I said, no, I'm not doing that. I'll come in as your business development growth guy, but I'm not going to do it until I saw a different way that they did it. But going to what you said, I realized really quickly if I walked in a room and said I was a insurance guy or a financial services, shut down. Everyone shut down. And I realized really quickly I almost never still introduced myself as that because I realized there's a lot of understandings about it. And people feel like they're the 5 or 10 friends and family.
Yeah, they have a preconceived idea of what you're going to do, how you're going to sell them, or even if you can help them or not, right? They've already made a decision. I'm not ready for that. I don't have enough money for that. Those kinds of things. But I want to stop you there because this is so important. And this is a concept that we teach in our Book Yourself Solid program is about how to actually answer the question of what do you do? Yes. And that's so powerful that you said, I oftentimes don't introduce myself that way. So how do you introduce yourself?
Yeah, I think I started to figure out, I think this is probably where the philanthropy side kind of comes in is like I can still talk about what I do, but it's not the lead of what I do. It's the second thing or the third thing I talk about. What I started really quickly, I started a foundation for my grandparents. They raised me and we do a scholarship back to my hometown. And so there's times I'll talk about that. But when I moved back to Utah, I started helping BYU, specifically Coach Pope, who's at Kentucky now, made it to the Sweet 16. So we'll see. BYU did too. So it's an interesting, and Calipari did too. They all made it. So I guess they switched teams and everyone's doing fine. But
it's funny, right? We root for we're actually rooting for jerseys, not people.
Exactly. So I was in a meeting with Coach Pope, and he said, "Hey, with this NIL stuff, I want to help my kids have financial literacy." And so we helped develop what was donations to create Roth IRAs for each of the players.
Wow.
And that was a better conversation with people when they'd come up and said, "What do you do?" And I said, I would say, "Oh, I own a wealth management firm, but this is what I do. We're actually just with BYU, or we're just with this. We're helping in the financial literacy space." I found that the financial literacy space, obviously, if I'm in it, they assume they must understand what I do and that I'm a part of it. But it's a lot easier to talk about because people then either talk about themselves or talk about their kids, talk about, yeah, we need that. Why isn't this taught in high school? But if I said I'm a financial advisor, they're like, no, I don't want to talk to you. And that's a very interesting difference because the financial advisor should be the one to be teaching
this
that.
stuff,
And people should be knowing that, but that they're feeling like they're being sold, not taught.
In a perfect world, when would you love to start teaching financial literacy to?
I've had this thought a lot. So I dropped out of UVU, interesting enough, but my last project was on the education system.
Yeah.
And pretty much found through my research, we could probably cut at least 2 years off of school and be done at 16. But maybe stay in the home at 16 to 18 to go to work and have a little bit
life experience.
Still be in the home, but go out in the world. And so your parents are there. Instead, they kick you out at 18, you get your first job. You're not even in your parents' home.
Right.
So, but everyone said, oh, I wish I would have learned this in high school. But the reality is they wouldn't have paid attention. Some of them would. But those ones that would have paid attention are probably going to be okay too.
Right.
So I think you have to embed it in probably more of math coming from story problems and really at second grade, third grade, fourth grade, fifth grade.
Yeah.
If you don't start then just doing a semester class at 16 probably isn't, maybe it works, but it's not going to be ingrained in the people. But I just don't know if our education system cares to do that.
Right.
That's the real honest truth is I don't think they have it. I mean, it's not that complex of a thing to be able to do, but they've obviously chosen not to.
But so vitally important.
For a reason. So, but I do think technology is maybe filling a gap. I think there's obviously negatives of technology, but there's also kids, because of TikTok videos and Instagram, obviously there's good information and bad information, but there's more information.
Right.
And there's more education. There's more, I was looking at a stat, there's more people in their 20s utilizing Roth IRAs than people in their 60s.
Wow.
Right? Because the 60-year-olds, it came in halfway through their working life that the Roth IRA was started. So a lot of them stayed away from it. They didn't understand it. These younger generations oh, I need to do that. Whether they fully understand why they're doing it or not, they're like, oh, somebody told me to do a Roth. And so I'm grateful for the education. But financial literacy really, it starts in the home. But not every kid's blessed to have parents that are going to know how to manage money. So how do you learn that? It really starts the education system. If not, really quickly, 18, 19, you got to figure it out.
Yeah.
If not, you're in trouble.
Well, not even that. There is parents that know how to manage money, but they were never taught by their parents, so they don't teach it to their kids. My mom is brilliant when it comes to money, but she was an accountant. She knows how to manage money and budgets and all of those things, but we didn't ever have discussions around credit cards, debt, how to manage money before I was out of the house. I learned
money's still taboo.
Yeah,
it's still very taboo.
It is. It's really interesting. It is still very taboo, and I don't know when that will shift or change generationally because it does get passed down. So it's really interesting.
One thing that I want to go back to that you said, Lacey and I do so much work with healthcare providers, and you mentioned a heart surgeon can work on a 60-year-old or an 8-year-old and apply their skills, and that doesn't happen a lot in the financial world. And I agree. But at the same time, one of the things that I love that analogy because I don't think very many people in the financial space see their job with the same degree of high stakes that a heart surgeon.
Yes.
There's so many people that just say, and we had conversations even over this weekend. We were at a wedding with a lot of friends and colleagues, and we were talking about there's just so much, especially in your industry, because you mentioned this, there's these sort of multi-level marketing structured financial tools or financial firms that are out there. And this bad advice can literally ruin people.
Yes.
And there's no accountability, right? You're just
Zero.
Oh, I just had this job and I was telling these people to do this thing. Well, how'd that work out for them? Well, yeah, that wasn't very good. And
it didn't work.
It didn't work. And, but there's nothing that in a medical space, if you are operating somebody and it doesn't work, right then, and there's a high level of accountability. What do you feel about? How can we get this? I think that's part of the reason why you're I don't want to say I work in the financial space, because people are well, I don't know. Are you the side of the road heart surgeon, or do you work at Mayo?
Yes.
And there is no side of the road
big
heart
gap.
surgeon.
Spectrum, right? A big spectrum of financial advisors on one side, and in a lot of professions, though. To be fair, it's that.
Yes,
but
yes, and because there's a second point that I want to go to, but I want to first understand from your point of view. What do you think about that?
it's all I think I thought about since I got into the space is how. I remember in a meeting, with a firm, it was one of my first experiences. I got to kind of bounce around. That was one of the things the brothers allowed me to do when I went to work for them. I went and actually visited other places, and because they had connections and buddies in the space, and so I just wanted to learn. And what I realized is, we'd sit in a meeting and I watched them just sell these people, right? And then we'd go back and they'd talk about all of these things. And in my head, I went, if doctors were in the back room talking like this, I would never go to a doctor again. Right, so
wow.
I experienced it on the side, and because the guys walking on stage at these big financial advisor or insurance conferences, they are awarded based on their business profitability or their money gathering ability. They are not judged by their ability to create great financial plans.
Right.
So I realized really quickly, I'm like, wait, I would never manage my money there. Like, I get it, they're a little bit more like McDonald's, but they're not. That's maybe we shouldn't be. No one's going to get their doctor, going to McDonald's to get their heart surgery done, right? Like, this should be at a higher level. This is people's money and a decision here and there. And there's going to be mistakes, but what's the intent of the advisor? But the industry is based on volume.
Right.
The entire industry is based on volume. That's why they've separated investment management, insurance management, tax management, estate management, healthcare managements have been really separated because it's easier to focus on one of them and do volume.
Right.
But
Makes
you
sense.
can't separate those 5 things because they're all interconnected to our wealth.
They all have to work
They all work
harmoniously together.
All of them
Yes.
do, but the industries will do, and you're starting to see the change start to happen.
Yeah.
But it's going to be it's not profitable for the change to happen for most of these firms. And so they're going to push back as long as they possibly can and then adapt to make, if you look at all the commercials, Schwab, Fidelity, Morgan Stanley, all of them now talk about wealth management. 2 years ago, they didn't. Because they're trying to get ahead of it and realizing, wait, people are realizing, why is the guy that's investing my money not talking to my tax guy?
It's got to be all under one hood.
Yeah, and it's if it's not, it has to be really coordinated, like it's under one hood.
Yes.
And until then, you're not going to have enough people that are critiquing the industry. I think as these industries come together, I think it's going to be easier to know, oh, wait, this financial advisor, wow, they're doing their investment management, they're bringing in the insurance guy, the tax guy, they're actually like a multifamily office for this person. They're a family office team. And I think you'll get better results, right? And you'll start, because there's more accountability, because there's more people involved in it, except just one guy controlling the millions of dollars of this one person, putting him into the investments that best benefit them. That's the name of the game.
It's so interesting because I think about this exact same thing when it comes to our healthcare system.
Sure.
The most damaging thing that we ever did was compartmentalize our healthcare, having providers not communicate with other providers when it comes to your overall health and your body. Like, somebody can't just be taking care of your liver and somebody else just be taking care of your digestive system and never have a conversation. You're never holistically going to get well. And the same holds true for your health or your wealth. But that's interesting because that's how the industry needs to begin to think to truly help people in the right way. My next question is, and I'm sure you get asked all the time, well, what do people need to do? What's your number one tip? I don't want to know what they need to do. I'm curious how people need to think.
Yeah. I think they need, number one, I mean, the easy answer is everyone just needs to learn it all and become knowledgeable in this. But I think the very first step that people need to take is they need to know how to hold these professionals accountable. Like, if that starts to happen, then it's natural that the advisors or let's call them the professionals start to adapt.
Sure.
Right? And I think that is a huge part. So what I mean by that is we'll have clients come in with their portfolio and we'll do what is called a beta and alpha assessment on it. Beta is a measurement of volatility or risk. Alpha is how well you performed versus the benchmark. So similar to healthcare, if somebody does your blood pressure, right? Like, I don't understand how they get that, but there's a standard, there's a benchmark, and that doesn't mean that we should just try to be the benchmark, but it gives us an idea of where we need to be. In the wealth management industry, they avoid talking about benchmarks, really, when they're comparing. And if they do, they'll say, well, the market's up 20, you told me you want to be conservative, that's why you're up 6.
Right.
And they'll blame it on the client to be conservative. And they weren't expecting to get 20, But if we find out, so beta,
But
S&P.
also, as a client, I'm sorry, like I don't even know what conservative means.
Well, no one knows. That's also what I said. Is if I raised a hand and they said conservative. These are these terms that they use: conservative, moderate, and aggressive. And no one could define it. If I asked 100 people, no one could tell me what it means. Really, it should be a benchmark, just like we do in healthcare.
Yeah.
Is the S&P, is used primarily as the benchmark. It has a beta of 1. So that means if you are conservative and your portfolio's at a 0.50 beta, another way to say that is you're taking half the risk.
Yeah.
So that means if the market is getting 20, you should be expecting 10.
Right. Right.
Now, it's not a perfect science, but that's a good idea of where you should be. So if you go in with your advisor and they're got $1 million and you made 6%, they're like, hey, you made 60 grand last year. Good job. And they're like, oh, okay.
Yeah.
I'm good. But if there's never a measurement to the benchmark, where actually the market did 20 last year, you're taking half the risk, you only did 6.
Yeah.
You're actually in a -4 alpha. You've underperformed your expectation by 4.
Huh.
This, I would say, honestly, Gary kind of runs he's my partner in this. He runs the investment side of this. He does those reports all day, every day. It's probably the single biggest reason why clients come on board with us.
Yeah.
Is because we're not even showing them what we do, honestly.
Right.
It's just, if you don't know where you are versus the benchmark, then you could love these people. They could be your family, friends, all these things, but you have no idea how to hold them accountable at all.
So important.
I think that is the easy first step. It's usually not question number 1, it's question number 2 or 3 that will, I don't use the word expose, but it really does expose, uncover what's happening in their portfolio, and they're being charged 1%, which adds another -1 alpha to their portfolio, right? Yes. And so Warren Buffett has said, if you don't know what you're doing, just be in the benchmarks.
Yeah.
Right? And I think that actually is advice number 1, is just like, if you don't know yet how to hold somebody accountable, probably stick to the benchmarks.
That's great.
Because at least I can walk outside, if the market's up 20 or down 20, I can at least say, with the top 500 companies in the world, I'm at least getting what they're getting or not getting what they're getting. I think most people can live with that to an extent, but that is the stepping stone to help them be better stewards of their money. But they got to understand risk. Right? And thankfully in the stock world or the securities world, at least the public, we can do all those measurements, right? It's all data we have. You get into the private market, a little bit harder, right? If you invest in restaurants or you invest in these things, your beta is much higher. Yeah. Right? So your ROI, if you put $1 million into restaurants and in 5 years, $3 million comes out, most people are like, oh, it was great. I invested $1 million, I made $3 million. But the reality is to take that risk, and maybe those restaurants, you probably needed a 10x return or a 12x return to take, because you could have went to zero. Because you could have went to zero. Right. Yeah, the risk is much higher. So
you want the outcome to be larger relative to the risk.
Relative, that's exactly right.
Interesting.
And so, but people don't talk about investments that way.
No.
They don't measure their investments that way, and that's pretty much the first thing we teach our clients is how to measure their portfolio. I don't care if they want to take high risk or low risk, but let's get to the expectation. So actually, as an advisor, they can understand the expectations. Yeah. That they know whether I'm doing good or bad, that I've taught them how to hold us accountable to the performance.
And that's such and I don't know if it's like a big aha for you, but that's such a light bulb moment for me. If I'm going to be taking greater risk, I expect greater outcome. And it sounds so simple, but you don't actively think about that. No, I don't want to take greater risk and end up with just $3 million. I want to end up with $10 million. That's the point of the risk in the first place, right?
100%. So we both walk out of the casino making $100,000. Me and Shawn both walk out. We both netted $100,000. We both put in $100,000. We doubled our money. Walking out, we both made the same amount. We think we're good. But the reality is, if I walked in there for 5 minutes, put a penny in the slot, won $100,000, and I sat there and ate food, I took very little risk to make my 100. If you're on the blackjack table, you're down a bunch, then you go on a heater, you come out. Yeah, you doubled your money. But the risk that was taken in that casino was very different, meaning the expectations should have been very different. But most people don't think that way. They think, oh, I made $100,000. It doesn't really matter how I made it. I made it. And that only works so long.
Yeah, and I think that's interesting. I don't know if you've ever contemplated this, but in most, if we look at healthcare and other professions that serve people, the provider has to have a philosophy. So obviously you have a philosophy around the way that you would structure someone's financial plan. You also have a philosophy around being held accountable.
Yes.
What would you say then is your general financial philosophy when you are approaching any client? Because I mean, and it would be nice, I think an advisor would like to say like, well, just temper it to the needs of the client, but still I've never met anyone in the financial space that's like, look, stay away from this, or I really like to get positioned here. How do you view that?
So we look at it, my partner and I, his name's Gary Pricer, we started to realize, it goes back to the conservative, is we were primarily working with retirees. That's how we started in Orlando. And I was a little bit more on the insurance side. He was on the security side. But what we realized is everyone was getting put in this box. Oh, you're 65 years old. You should be in this 60-40 portfolio, 60% stocks, 40% bonds or annuities or whatever was being sold by the person. The reality is we'd have clients come in and they had great maybe rental income, they had great pension, Social Security, and their portfolio was designed the same way. And they're like, I'm like, why is this like this? They're like, well, we're conservative. And so they put them in the same portfolio. And I'm like, no. But for you already have cash flow. You don't need 40, 50% of your money in this specific place. This is used for income. But if you don't need income, your portfolio needs to be designed very differently. So we wrote a book called Cashflow Clock, where, the pie charts, everyone uses the pie, but we made it a clock to say, hey, your investments really should be based on when you need that money. And for every person, that's going to be very different. Right? And then we look at the risk. If they're running a business, they have great cash flow, but that business could end, right? So you've got to look at the different parts of it. But the cash flow clock gives us, especially for retirees, is saying, what money are you going to use in the next 1 to 3 years, right? That you need accessible. Okay, well, we're not probably putting that in Bitcoin. We're probably not putting that in some of these other things. Now your 3 to 7 years, that can be invested differently. Your 7 to 15. And then when you get into like 10, 15 for retirees, they're not touching that money, most likely, right? And so it's helping them understand that. Then you add the tax layer on it. We have people that come in with their portfolio stocks and bonds, and they have a Roth IRA and a traditional IRA, and they're invested identically the same, even though they have very different tax attributes. Well, no, your Roth should be the last money you touch, so that's where maybe your stock should be, or your higher aggressive part of your portfolio, because that's the money you should touch last. And so our philosophy comes around the cash flow clock. We got a book, and it helps us give at least a foundation of an idea for that client. But then, like you said, we've got to tailor it to them, right? Like we've got to look at all of these options. But when it comes to investments, the reality is every investment, like right now, interest rates are high. So bonds, bond yields, annuities, CDs, money markets, MYGAs, those are all going to be high. They're going to look really attractive, right? And so people are going to get them, and they're going to have a good experience with them. And then 5 years, interest rates are going to be low. And their neighbor talks to them, and they're going to say, hey, yeah, I bought this annuity, and it was great. And so they're going to go buy one at interest rates when they're low.
Right.
And they're going to have an awful experience.
We were just talking about
and so
that.
But that's where all this like opinions are like annuities are good or this is good. It's like, no. Just zoom out for a second to say there's at times, there could be a lot of these investments that could be really strong, but we can't get so focused that that's good or bad. Most of it has to do with timing and the economic situation that we're in, and a lot of it is based on interest rates.
Yeah.
Like that is the biggest indicator of what people should be in. The problem is these retirees over the last 15 years were told to be conservative, so half of their portfolio was in bonds, and bonds almost negatively performed.
Right.
Because interest rates were at all-time lows.
Yeah.
Right? And so, but the advisors wanted to make money and build the bonds where they probably should have spent in cash. But you can't build cash.
Yeah.
Oh.
There you go. So now it comes the layers of why people do. The Fed came out in 2021 and said, we're going to raise interest rates.
Yeah.
Right? And that was a sign to say, if we're in any bond that is lower than this, like we got to get out. Because if we don't, we're just going to lose our value or hold to maturity. Like we've got to decide. But what did firms do? They didn't do anything. Because they couldn't lose 40% of their revenue.
Right.
They're just going to lose 40% of their revenue. No, they're not going to do that. And maybe we probably don't want that from an economic standpoint because it would have crashed the system. But if I'm an individual, I want to get my client off the boat.
Right.
Maybe I don't want the boat to sink, but I want to get them off the boat. That stuff's not happening because no one's paying attention to the economic aspects of it. So the cash flow clock's like our basis.
Where do people get that?
It's online. It's on our website. We have a link to it. And
what's the website?
So stonebriarfinancial.com.
Stonebriarfinancial.com. We'll put that in the show notes.
Yeah, absolutely.
And Gary's like the mathematic. It was like really, it looked like a scientist wrote this book. And now we've got to go get it like pictures and make it look a little nicer, but the information's there. It's good. The right information. Now we just got to make it look pretty.
That's more your jam. You can read that because exactly. I'm not the scientist math brain for sure in the relationship.
I have one last question because knowing that typically entrepreneurs are who watch this or listen to this podcast. How do you temper that advice? Because entrepreneurs have a different risk tolerance, right?
Yes.
And they're taking all their money and putting it back into the business and back into the business. And that's honestly where I met you, was in entrepreneurial spaces. So tell me, how do you shift your advice when you're speaking to an entrepreneur versus the bulk of your portfolio initially being in the retirement space?
Yeah. No, I think that's exactly the movement that we've started to switch to is when do you take risk off the table? Right? And so we just had an individual in our office. He's actually in his late 20s, but he's doing $20 million a year in revenue. And he's just investing back in, which is amazing. Like my entrepreneur brain goes, just keep doing that, right? But then at the same time, we're helping him design his family office to say, okay, at one point you've got a wife and you've got kids. Like you can start to put money away and start to, give yourself that, take risk off the table, right? There's not a perfect answer to it, but it's helping them understand. I think Shaquille O'Neal said his single best investment he ever made was an annuity. And it wasn't because it was the best ROI. It probably was the worst ROI of anything he had in his portfolio at the time. But he bought it after he almost lost all of his money because I think at 55 it would pay him a couple $1 million a year. In his head, he knew he had secured it, and then he took way more risk.
Right.
Which actually created, so if you look at it and saying, well, that didn't, but the decision changed the way he looked at it because in the back of his head, he said, I knew I have it.
Yeah.
And I think that's where I guess I'm trying to work with these entrepreneurs to say at one point, not to buy an annuity, but the idea is like whether that's rental properties, whether that's other investments that are separate, find something, when you have it, secure it, and then go even more risk. Instead of what happens as they get older, they just keep taking risks and then they just pull back risk on their business and then their business dies.
Yeah.
Right? Instead of like actually maybe creating not a new business, but setting stuff aside that isn't correlated with your own business. And I think Ray Dalio he's probably extreme on this, but like having non-correlated assets, we have to start doing that with the entrepreneur. It's just at what point do they do that? And I think it's what you'll see actually in the wealth management space, and it's starting to happen, we're doing it, is you'll start to see all these private equity firms are kind of telling us who they're going to go after in the entrepreneur space. What we're doing on our RIA side is finding advisors that come from that space, similar like you guys in, chiropractor and those things of like the next phase of wealth management is going to be the firms that specialize in that type of business so that they can also give them business development direction at the same time helping them navigate the financials. So we're coming to their space more than them, because if we try to pull them to our space, they're like, nah, I don't know that this is corporate. I don't like this. If we can actually go to their space, understand their business, one of the biggest RIs in Utah is dentist advisors. They just focus on dentists. But really half their business is, hey, we've got a group of mastermind of dentists that can bring massive value to your business, but also show you how somebody else did it. And not all those are going to be the best examples, but in the law of large numbers say there's enough good information here. So, so I think you're going to see that start to change, where we're going to go into that space. The wealth management's going to go into that, and hopefully give a better direction for those people and go where they are so they can understand. But entrepreneurs are tough, man. They're still, you can talk to them all day. They're still going to take the risk, which is why they are who they are. And so it's a fine line.
I love that. I'd love to collaborate with you because I see that we've taken a look at several niches, especially through the Book Yourself Solid product, where we can begin to bring that, and we're doing that in the book into different verticals, penetrate that market, and love to collaborate with you on the financial side.
It's happening, and I think entrepreneurs will respect the advisor or the group, right? Whatever it is, when they understand their business.
Right.
Yeah.
Like
100%.
That, that's what it's helped in the retirement space is I actually was raised by grandparents. I know exactly what life was in retirement.
Yeah.
So it helped me relate to them and say, I've experienced, through living with my grandparents, what you're about to experience.
And what you're going to experience,
But if we can have somebody that comes from the parents were in the construction world or whatever it is, and he becomes an advisor, he can relate to those people much more on that side, and then bring them to the education of the financial literacy of the understanding. And
100%.
I think that is going to be a huge part of the future of wealth management. Hopefully.
Yeah. Yes, hopefully.
Because I think it will bridge the gap and help these entrepreneurs actually build to sell, right? Understand how an exit works, structure themselves, maximize their 401ks, their super backdoor Roths. Like, they're not doing it.
No.
And a lot of it is because, why would I do that? I'm getting a 10x return on my money I'm putting into the business.
Yes.
And that's amazing. But there has to be a time where you separate it.
Because the 10x was only a 7x once we took the 3x's off the table with taxes and all this stuff because you didn't plan it.
You didn't plan it.
And then it didn't look as great. Shea, thank you so much for being with us. How can people get in touch with you again?
Yeah, so stonebriarfinancial.com or Instagram is usually where I'm at. It's at Shea Swenson. That is the easiest way usually to contact me. Emails I like don't even look at. It's so hard anymore. Like text messages.
It is really,
text messages and Instagram is like the spaces that's easiest for me to
communicate
help.
and connect. Yeah.
So that would be the 2 places for sure. On LinkedIn, it's Shea Swenson as well. So
stonebriarfinancial.com. Make sure you get connected with
Get the book.
Shea. Get the book. Check him out. And also, listen, if you're one of those guys that loves to win your member guest, you just get this guy as a guest.
Yep.
He'll ensure a win for you. All right, everybody. That's it for this week. We'll be back again next week with a brand new episode. Don't miss it right here on the None of Your Business podcast.